Welcome back to the third and final video of the Profit Logic Accounting 101 series. In the first two lessons, you watched three young friends go from mowing lawns to renovating a clubhouse and running a full-fledged mini business. And as they grew on their entrepreneurial journey, so did you with your accounting knowledge right alongside them. You learned what assets are, what liabilities means, how equity changes, why expenses matter, and how revenue becomes profit. And if you're brand new to this series, welcome. I highly encourage you to pause this video and make sure you start with the first video of the series, which I'll link to up top. That way the story flows and makes sense because each video builds upon the one prior. So now we're stepping into the last and final and arguably most important chapter of our story. Because today we're going to talk about something pretty much every business owner eventually feels at some point. Which is to say, my income statement says I earn money, but my bank account kind of feels empty. This final lesson is going to explain that confusion once and for all. By the end of this video, you're going to understand why cash and profit are never the same thing, how depreciation works without cash ever leaving your account, how liabilities like loan payments look on paper, and most importantly, how the balance sheet, income statement, and now what I'm going to show you next, the statement of cash flows, all come together to tell one unified financial story. And if you enjoy simple story-driven lessons with lots of examples about accounting, bookkeeping, and QuickBooks, don't forget to subscribe to this channel. All right, take a deep breath. Let's step back into the world of the Fix-It friends one last time. So we watched the friends start by mowing lawns and painting fences, pool their money together, get a loan from mom, purchase a lawnmower, fix up an old clubhouse and turn it into a rental property, build up an inventory and sell some snacks, track revenue, expenses, and equity along the way, and keep everything balanced with our accounting equation. Assets always equals liabilities plus equity. So now the friends are sitting inside their improved and clean clubhouse, the fairy lights glowing overhead, with the scribbled homework club rules still on the whiteboard, and their cash box sits open on the table. Jordan flips through the notebook with all their numbers, and he says, "Hey, it looks like we made a ton of money." But Sam shakes the box. "But it doesn't really feel like we have much in here. So are we struggling but also successful at the same time?" Welcome to the emotional experience of running a business. Every entrepreneur feels this tension at some point. The financial statements might say you're doing really good, but your bank account might say something different. And this moment right here is why accountants created the statement of cash flows. We need a way to monitor the movement of cash flowing into and out of the business. Let's walk through an entire week and show you what's really going on. So before anything happens, we need to start with our scorecards. Because if the beginning is wrong, then everything after that is going to be wrong as well. Under assets, what we have is $100 in cash, a mower worth $50, clubhouse improvements worth $30, for total assets of $180. Under liabilities, what we owe, we have a loan from mom worth $25, accounts payable worth $15, for total liabilities of $40. And for equity, what really belongs to the Fix-It friends, we have equity worth $140. So our liabilities plus equity equals $180 total. Everything matches. Everything's balanced. We are good to go. So until this point, we've used two scorecards primarily. We've used the balance sheet, which shows what the business owns and who it owes, and the income statement, also known as profit and loss statement. And the income statement shows the sales, the expenses, and the bottom line, our profit, which then turns into equity on the balance sheet. But something's missing here. If the balance sheet shows what we have and the income statement shows what we earned, which statement shows cash? And what happens to cash? That is where we bring in the cash flow statement. The cash flow statement shows us only cash in, only cash out. No promises, no IOUs. So now we have like a 3-camera setup filming the business. We have the balance sheet, which shows our position. We have the profit and loss statement, which shows performance. And now we're going to have the cash flow statement, which shows us what's actually in the bank. And if all three don't tell a consistent story, then something's off. All right, so it's been a few weeks, and the mower rests in the grass. Its paint is a bit more dull than when they bought it, and now the handles are kind of slightly wobbly as well. Jordan points to it and he says, "We've used it for weeks. This lawnmower can't be worth $50 anymore." So the kids agree that this mower probably has about 10 more months left to go. They decide to split the entire worth of the mower over 10 months, so a rate of $5 per month over 10 months. This is going to be the rate of depreciation. Therefore, this month, they record $5 of depreciation. Let's see how this impacts our accounting statements. On the income statement, we're going to record a depreciation expense of $5, which ultimately will decrease profit by $5. And on the balance sheet, we have our lawnmower, which was a value of $50, decreased down to $45. Our equity has gone from $140 down to $135, and our cash is unchanged. So our total assets are 100 plus 45 plus 30 for a total of $175. And our liabilities show $40 plus equity of $135 for a total of $175. And on our cash flow statement, there's no cash movement, so cash is just staying at $100. The friends realize that some expenses don't touch cash at all. So moving forward, remember when the kids purchased those cleaning supplies in the last episode? The owner of the corner store ends up coming over to the kids holding a receipt. "Hey kids," he says, "I misrang your cleaning supplies last week. They actually cost $5 less." So these kids get a $5 credit on their account. Therefore, on the accounts payable, it goes down from $15 to $10. But remember, when we reduce accounts payable without cash, that also means our equity is going to be impacted as well. And in this case, it's going to increase the equity. The accounting equation always needs to stay balanced, even if the change only occurs on one side of the equation. So our balance sheet shows accounts payable going from $15 to $10, and our equity going from $135 to $140. Assets still stay at $175. So let's check the equation. Assets of $175 equals liabilities of $10 in the form of accounts payable plus a loan of $25 for a total of $35 plus equity at $140 for a total of $175. Perfect. So the kids jog over to the corner store to settle their balance. So they open their cash box and hand over a $10 bill. Let's look at our cash flow statement. Our cash is going from $100 to $90. Let's look at the balance sheet. Our accounts payable has gone from $10 down to $0. Now our assets show $90 in cash, a mower worth $45. Remember, we reduced it because of depreciation. A clubhouse with improvements worth $30, and total assets of $165. For liabilities, we have a loan to mom worth $25, and our accounts payable is now down to $0, and our equity is still staying at $140. And when we check it, our liabilities plus equity is $25 plus $140 for a total of $165. This is looking good. Okay, so mom ends up coming by, and she knocks on the clubhouse door, smiling gently. "Hey team," she says, "I need $10 of the loan back this week." And Jordan proudly and happily hands on over $10. "Okay, this is great," she says, "but that wasn't a forward on your allowance. That was a bona fide business loan. I actually require 10% interest for the privilege of borrowing the money in the first place." So Jordan, a little begrudgingly, hands over an extra $1. So now, does this mean since the kids paid her $11 that the $25 that was owed to mom is reduced by $11 and is now $14? No, they still owe her $15. The $10 that was paid initially is what's known as money that was paid on the principal of the loan. This is part of the money that was originally borrowed. And that extra dollar paid is what's known as interest. And it's an interest expense for the business. This is the cost of borrowing money. And interest paid on a loan is a business expense. So we have $10 paid down on the loan principal and another dollar paid as interest expense. Let's look at the statements again. Our cash flow statement shows cash going down by $11, so from $90 to $79. Our balance sheet shows a loan worth $25, now shows only $15 owed. Our cash is $79. Our other assets, $45, $30 total to $154. On the liability side, liabilities are worth $15 and nothing for accounts payable. And under equity, our $140 is reduced by $1 for the interest expense, bringing it down to $139. So assets worth $154 equals liabilities of $15 plus equity of $139 for a total of $154. Interest lowers profits, and loan payments on the principal lowers cash. These are actually two separate transactions. So another Friday night rolls around, and the kids settle into the familiar movie night rhythm. The string lights warming the doorway, the projector humming. The Fix-It friends move through their setup like they've done it for weeks, arranging the chairs and snacks with quiet confidence. Then a parent steps forward and places $40 in cash into the box. The bills land with a soft weight that confirms that the clubhouse has become something real and valuable. There's no cheering, just a shared sense of satisfaction as the Fix-It friends absorb the moment. Movie night club is a hit again, and the business is working. Let's look at our statements. Under the cash flow statement, we see cash go from $79, increased by $40, for a total of $119. Our income statement shows revenue with an increase of $40, so our net profit increases by $40. Our balance sheet shows cash at $119, the lawnmower worth $45, clubhouse improvements worth $30, for a total assets of $194. Our liabilities include a remaining $15 owed to mom, and our equity shows $139 plus $40 of profit from the week for a total of $179. Let's check. 15 plus 179 equals 194. We are balanced. The next day, the Saturday morning light shines through the windows. The Fix-It friends sit at their wooden table, staring at two numbers, feeling a little bit confused. The profit for the week was $34, and the cash gain for the week ending at $119. Jordan looks a little stunned. He realizes we earn money, but cash doesn't really go up that much. He looks through all the different statements. Depreciation lowered profit, but it didn't use cash. Paying the accounts payable lowered cash, but it didn't reduce profit. Paying mom lowered cash, but only part of it hit profit. Revenue increased both cash and profit. Sam summarizes it up perfectly. Profit tells the story of performance. Cash tells the story of survival. They look at their financial statements and they see the magic. Income statement shows what was earned. Balance sheet shows what we have and who owns it. And cash flow statement shows what actually moved. 3 angles for one business telling a complete financial story. All right, let's take this home. The sun sets behind the clubhouse, painting the yard in shades of gold and apricot. Inside, the Fix-It friends gather around their wooden table for what feels like their final meeting of the season. The ledger lies open, pages worn from weeks of use. The week's transactions are complete. Every renter is paid, every snack accounted for, every supply purchase recorded in the rightful place. As they look at the totals, they see the business in full form. What it owns, what it owes, and the value left over for the owners. Let's say another kid wanted to buy this enterprise from them. Where they would look to see the value is on the balance sheet. That would help guide the price, knowing how much the business is actually worth. The building blocks of value on one side and the obligations on the other, and the owner's true stake sitting at the end. It is the cleanest snapshot of what they've made with their creation. With the summer wrapping up, the kids decide to finally reward themselves. They want to do something small but meaningful. So they pull $15 from the cash box to go get ice cream together, a little celebratory reward for everything they've learned. And the question naturally arises, should this $15 be recorded as an expense? Or is it an owner's draw, reducing equity but not touching profit? The answer should be pretty clear by now. Ice cream is not part of running the clubhouse. It doesn't help earn revenue or maintain the building. It is not an operating cost. It's just a pure moment of joy for the owners. So it's a distribution, not an expense. So the kids reduce the cash account by $15, and they also reduce equity by $15, leaving every statement intact and honest. Their final balance ends here. The Fix-It friends step outside with their ice cream, the clubhouse glowing behind them. They close the door gently, not because they finish forever, but because they've grown. They understand how value moves, how money tells a story, and how a business breathes over time. They didn't just run a clubhouse. They built something real. And they learned how to read it, measure it, and celebrate it. Graduation day comes quietly, with the sun setting and the books closed, and the Fix-It friends walking home with the confidence of true business owners. So if you followed the Fix-It friends all the way from mowing lawns on an early summer afternoon, to patching a broken clubhouse, to managing supplies, tracking who owns what, handling debt, depreciation, accounts payable, accounts receivable, and the mystery of why profit and cash are never the same thing, you should now pause and congratulate yourself, because now you know the backbone of accounting. Not the 10 minutes or less version, nothing oversimplified. This is the real thing. These may be kid examples with a little bit of kid logic, but they're also the exact same principles behind every QuickBooks file you'll open, behind every QuickBooks transaction you'll ever record, every tax return a CPA signs their name to, every financial statement that a lender will review, and every cash flow puzzle that a CFO might solve, and every business owner trying to make sense of their numbers. This is the same fundamentals of accounting applied to all. You've seen how assets, liabilities, and equity all move together. You've watched revenue flow into profit and profit flow into equity. And you've seen cash move around for reasons that the income statement can't even explain. And you've seen the balance sheet tell the long-term truth while the week itself might have felt messy. You've come to understand in a deep way 3 financial reports: the balance sheet, the profit and loss statement, also known as the income statement, and the statement of cash flows. And you've seen them locked together into an honest financial story. And most importantly, you've seen that none of this is magic or a kind of calculus. It's structure, it's logic, it's organization, all coming from different business choices. And once you understand the pattern, accounting becomes one of the most empowering languages in business. If this series has helped make you feel less intimidated by the numbers in your business, or able to finally make sense of financial statements and walk away being able to speak some accounting jargon, then you are already far ahead of many entrepreneurs who don't take the time to learn accounting, and therefore don't know how to make sense of the numbers behind their own business. If you want to keep learning more about accounting, bookkeeping, how to use accounting software like QuickBooks in a fun, simple, easy to understand way, then make sure you're subscribed to this channel. Thank you so much for watching, for following the Fix-It friends on their journey, and for taking the time to invest in your own financial clarity. I will see you all in the next video.